If you think the stock market is overvalued at these levels, I have a perfect solution for you. And it involves options. And what you would do is you would sell a put option against the company that you would like to go long, something that you want to hold forever, but you think it's a little bit unreasonable at these current levels. And the benefit is that you would also collect a premium, which is very similar to a dividend. And it's essentially you're getting paid to wait. So we'll be discussing this in entirety. We'll discuss a little bit more about options if you're unfamiliar with what that is. And then we'll go into detail with an example of an option that I put in the market over the past couple weeks. But if this is your first time here, my name's Nick. Welcome to Ways to Wealth. Before we get into the video, huge favor, huge ask. If you learn something new or you get some value out of the video, hit that like button for me. And if you haven't already, please consider hitting that subscribe button and turning that notification bell on. I would definitely appreciate that. With that being said, we're going to be relying on Questrade, definitely my preferred platform, and they do a little bit of a breakdown about trading options. So first and foremost, an option is different than a stock in the sense that you're writing it for a future date at a particular price. And then also, are you going to be obligating to buy it or are you going to be obligated to sell it? So there's a few different things that are going on here. Today, we are talking about put options. So keep that in mind. We're selling it. We'll explain a little bit further about what that means, but let's just go over the basics right now. So options are contracts with three components. It's the option or obligation to buy or sell an investment in the future. The specific price is called the strike price. So that's what it's going to be bought or sold at, that number. And the third is the expiration date after which the contract becomes worthless. So what we're talking about today is put options. So let's read a little bit about that. So the writer of a put option takes on the obligation to buy 100 shares of the underlying at the strike price upon call to do so. So basically, I'm looking at companies on my watch list that I would love to own, but I think at these levels, they're particularly overvalued. So do I really want to own Tesla at 1200 or do I want to own Tesla at 900? So we're going to be talking a little bit more in depth. I know that one seems like a no-brainer and it seems like the math is way off. But in this particular past couple weeks, what I do is I look for volatility. So one of the companies that I came across was Penn. After earnings, it particularly got hit. Now, full disclosure, I didn't know the full story behind it. When I made this move, I thought it was particularly just earnings, but just based on the premise that this company got hurt on a negative basis is when I saw the opportunity to strike. So Penn is not only do they have retail outlets in terms of actual physical casinos, they're trying to break in to the sports gambling side of things, and that's where Barstool comes into play. But I think it's a decent company on its fundamentals. I think, if you look at the macroeconomics behind sports gambling, I think this company could be the company that takes it forward. So we'll take a look here and we'll look a little bit further as to what happened. So we see here on the Questrade screen, we see it was at 58.25 on Friday. But the trade that I did was a couple, I think November 4th when they reported, but it had dropped like 14 or 15% in a day. So I was taking a look and I was like, okay, there's a lot of volatility in this name right now. Volatility meaning that, the price action is very big. And this could be a perfect candidate for selling a put option because implied volatility is a big factor as to what kind of premiums that you can get. Now, what does that mean? It means that if there's a lot of turmoil, a lot of, volatility, a lot of negative press, good press, it means that there's a lot of action behind it and it drives the premium up. So what I did is I looked at something far out in the future. So when I look at the contract date, I wanted something very far in the future. So I said, hey, March 18th, hopefully the Super Bowl is at the end of February and there's some positive catalyst that kind of helps bump the stock higher than it is today. So that, realistically, I can just collect the premium and not have to actually physically buy the shares. So what we'll see here is the strike price is in this column in blue. So this is the price that I would want to buy it at on March 18th, which is the day that the contract would expire. So by writing this, I'm saying, hey, if on March 18th, 2022, the shares are 40 and below, I'm going to buy 100 shares. So one contract equals 100 shares. I think that's important to note because it's good to have this cash sitting and waiting, because if they do happen to, go through, you don't want to be going through on margin. It is also important to note that this can only be done in a margin account. It cannot be done in registered accounts, and it's also a level 4 in Questrade in order to do this. So I'm saying here on March 18, 2022, I'm going to buy the shares if they are 40 and below. And we can see here that the premium last traded at 9. So because one contract equals 100 shares, I multiply that out to see that it's 900. So if I sell the put that gives me the obligation to buy in March, I collect $900 to wait. And because that premium might seem high, and it is really high, that's because there's so much volatility behind the name. And it's also a company that if it does go to 40 and I am obligated to buy it, I don't mind going long, because I think this company can be one of the good companies of the future. So just going down and breaking down some easy math, I'm sitting here and I'm saying, okay, $900 in terms of, collecting that today. It cost me like $20 to do the trade. So that's like relatively low in comparison. But if it does drop to 40, hypothetically, right? So that would cost me $4,000. I would then take off the $900 that I would receive in premium. And essentially, I would only be paying $3,100 for 100 shares, which drives my cost down to $31 a share, right? So looking at it like that, 31 becomes my cost basis if I own 100 shares. So that's even of a further discount if the company does get down to that 40 level. Now, what happens if the company stays above that level? Let's say at the time of expiration on March 18th, it's 41. Well, that just means I'm in the clear. I put my $900 in my pocket, will clean my hands and move on to the next trade. It's basically the premium that I've collected is almost essentially like a dividend. And I think it's not considered dividend income. So I think there's some tax benefits there, but I'm definitely not a tax lawyer or an accountant by any means. So definitely get that checked there. So basically I'm sitting here and I'm looking at it from a realistic standpoint. If the shares are at 58.25 right now, and for them to get down to 40, they would need to continue to drop 18.5 divided by the stock price today. They would need to drop another 31% to get to that level. Now, can it happen? 100%. I'm not saying that it's not going to happen. It's easy money, 900 in the bank. I'm not saying that at all. What I'm saying is that the probability of it dropping another 30% after it's already taken a hit is probably unlikely. Now, if it does, what I'm saying is I'm picking a company that I like and I wouldn't mind holding the shares for the long run. So I'm buying it. I'm saying, hey, I want to own Penn for the long run. I don't like 58.25. There's too much risk right now. But if I got in at $40 a share, I'm a buyer. That's it. And then I also get this $900 in the interim. So it drives down my cost basis. If I do end up owning it, or it's essentially like owning a dividend. So let's say hypothetically, we would take this $900 level and we would divide it by if I were to buy the shares straight up today, 58.25, that would be essentially like a 15% dividend. Or I'm protected if the stock ends up going 15%, then I'd break even because I would be collecting this money anyways. If the stock ends up going 15% or over, I'm technically out on that money. I would have been better off just buying 100 shares of the company, but at least this gives me a little bit of protection because like I said before, if it ends up the day on March 18th at 41 and over, the deal expires worthless. I still collect the premium and that's it. So we can take a look here. We can see the pen March 18th, 2022, $40 again is the price. It's one contract and it's a put that I've sold. So when you go in there, you click sell instead of buy. One is filled at the $9 per share, which is $900. So that's definitely the way that I'm playing to get into companies that I think are overvalued right now, that I think the stock price is a little bit too high. And then I go in there and figure out what price I'd like to buy them at, and then collect a premium, a little bit of a dividend while you wait. So I hope I've alleviated some of your concerns. Obviously, I have that 4,000 in a cash account waiting to go. So if it does drop down to that level, I can be a buyer. But I hope you enjoyed the video. I hope I give you a little bit more of an explanation about using put options to get into companies, especially if you want to be owners of them for a long time, but you think they're just a little bit overvalued right now. So let me know down below. Are you familiar with this strategy? Do you use this strategy today? I hope you all have a great week in the markets. Happy trading.